There is a point in every market cycle where loan officers have to stop asking, what is happening to me? And they need to start asking, what is this season trying to teach me? Because every cycle teaches. Hot markets teach one set of lessons. Tight markets teach another. Refi booms can make you look better than you are. Purchase markets can expose every weakness you've been hiding behind momentum. And if we are being honest, and you know what? Let's be honest. That is exactly why so many originators struggle when the market gets harder. It is not because they're incapable. It's because opportunity disappeared. It's because pressure reveals the truth. It reveals who built a business and who borrowed one from the market. It reveals who has habits and who has hope. It reveals who has structure and who has vibes. It reveals who knows how to think like a business owner and who is still operating like a salesperson, waiting for the next easy season to save them. That is what today's episode is all about. Because buried inside this transcript were 4 business lessons, and every one of them matters for loan officers right now. Not theoretical lessons, not conference stage lessons, not motivational poster lessons, real lessons. I'm talking hard lessons, and in some cases, expensive lessons. The kind of lessons that shape what kind of originator you become over the next 2 years. And if you are a loan officer in 2026, this matters more than ever. According to Freddie Mac, the average interest rate is sitting right at 6%. According to the National Association of Realtors, existing home sales are running seasonally a little bit better than they were a year ago. In other words, this is not a dead market. It is a market that demands more from you. I'm Dustin Owen, and this is the DO Show. They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. The first lesson is this. Too many loan officers live in the gap instead of the gain. This one hits hard because high performers are especially vulnerable to it. I know from firsthand experience. You set a target, then you set a bigger target. You compare yourself to the top producer in your market. You compare this year to the version of the year you imagined you were going to have in January. You compare your actual pipeline to your ideal pipeline. You compare what is happening to what should be happening. And before long, you can be making real progress and still feel like you're losing. That is the gap. The strategic coach framework behind the gap and the gain, which quote unquote, the gap and the gain. It's a book. You should go read it. It's built on the idea that entrepreneurs often make themselves miserable by measuring against an ideal instead of against actual progress. That is not some cute mindset trick. That is a business survival principle for loan officers. Here's what that looks like in the mortgage industry. An originator says, I'm only closing 4 loans this month. But what they fail to say is that a year ago, they had no referral partners, no repeatable follow-up system, and no clue how to structure or consult a borrower. A branch manager says, we're behind where we wanted to be. But that branch manager fails to recognize that the branch is operating cleaner. Their originators are more coachable. And as a group, they're more resilient than ever. A producing manager has been heard to say, oh my God, this market is killing me. But the truth is that the market did not kill them. The market exposed that they never built a process strong enough to operate without easy refis. When you live in the gap, every win feels small. Every result feels late. Every month feels like proof that you're behind. And that's dangerous because it leads to panic. You chase shiny objects. You hop companies for emotional relief. You overreact to one slow month. You start blaming the market for weaknesses that, well, they're already a part of your business. You stop doing the boring activities that actually build momentum because they do not produce instant gratification. That is why measuring gain matters. Not so you get soft, not so you get complacent, not so that you stop chasing bigger goals. No, I want you to think big, and when you're done, you think bigger. But you do this because if you cannot accurately see progress, you will not manage yourself well enough to sustain progress. For an LO, gain looks like this. You are asking better questions in borrower calls. You are getting more direct referrals from past clients. Your realtor meetings are more intentional. Your database outreach is less random. Your confidence is not dependent on whether or not rates go up or down. You understand your numbers better. You recover from setbacks faster. That right there, y'all, that is gain. And if you ignore it because it is not yet the final version of success you imagined, you will talk yourself out of the very business you are building. This matters on a leadership level too. Gallup said U.S. employee engagement fell to 31% in 2024. That's the lowest level in a decade, and it remained at 31% in 2025. Know this. Leaders who make progress feel invisible create tired teams, and tired teams do not build great businesses. So here's the practical takeaway for LOs. Stop ending the week by asking only what didn't happen. Also ask, what got better? What conversation did I handle better? What objection did I navigate better? What relationship did I build stronger? What system did I improve? What discipline am I keeping now that I used to break? Because in a purchase-driven market, like the market we're all in, confidence is not built by pretending the market is easy. It is built by learning to see real progress while the market is hard. The second lesson is this. If your gut already knows something is misaligned and you have honestly given it a real shot, staying too long will cost you more than leaving. This is one of the most uncomfortable truths in the business because loan officers and mortgage brokers are told to grind. We're told to push through, stick it out, keep going. And sometimes that advice is right. Sometimes the answer really is more reps. It's more consistency. It is more patience. It's more resilience. But not always. Sometimes what you are calling patience is just fear with a business card. Sometimes you already know the branch is wrong. You already know the team fit is not right. You already know the compensation setup is not in your favor. You already know your referral model isn't the one that you should be running. You already know that the people around you are not helping you become the version of yourself you're trying to build. And yet you stay because change is uncomfortable. Because starting over feels expensive. Because the known pain feels safer than the unknown opportunity. That is where mortgage brokers and loan originators burn years. Not because they fail dramatically, because they linger. They stay in a place they outgrew. They stay in a structure that doesn't develop them. They stay in a business model they know is too dependent on random referrals, weak partnerships, or one legacy source that's drying up. And the cost is not always obvious at first. You can still make money in the wrong environment. You can still close loans in a misaligned model. You can still look fine from the outside. But internally, when you listen to your gut, you know whether your current setup is calling more out of you or slowly shrinking you. You know whether your current relationships sharpen you or sedate you. You know whether you are building something transferable or durable, or maybe you're just surviving 1 month at a time. This is why this message is all about trusting your gut. It's what matters. If you have honestly put in the work and you know something is off, then you need the courage to tell yourself the truth. That does not mean impulsive decisions. That does not mean every rough quarter means blow everything up. It means you ask a better question. If nothing material changed in this environment over the next 12 months, would I still choose it? Would I still choose this branch? Would I still choose this manager? Would I still choose this model? Would I still continue to prospect the way that I am? Am I marketing the right product mix? Am I actually running the right schedule? Is this the identity of a top producer? Is this who I want to be? Because if the answer is no, then the problem is not just the market. The problem is misalignment. And misalignment compounds. It steals time. It dulls your edge. It erodes ambition. It makes you play defense. It turns gifted originators into cynical people. One of the most expensive mistakes in this business is staying where you no longer belong because you want more certainty before making the move. The certainty rarely comes first. Listen, y'all, nothing changes if nothing changes. Conviction comes first, then the move, then the growth. The third lesson is this: intentionality beats wishful thinking every time. This is where average originators separate from real business builders. A lot of LOs are not underperforming because they lack talent. They're underperforming because they lack intentionality. They are well liked, but they are under systematized. They are capable, but they're just unstructured. They work hard, but their priorities are a little bit fuzzy. They call that hustle. Sometimes it's disorganization. Look at how many originators run the same play year after year after year. They do a few referral lunches. They'd make a couple social media posts. They send some random text to their database. A little panic as soon as the month gets a little bit light. A burst of activity at the month's end. Then they call the result the market. No, y'all, that is not the market. That is drift, and you're drifting. Intentionality means deciding what business you are actually building. Who is your ideal borrower? Who is your ideal partner? If you're going to run a niche, which niche are you going to pick? What is your weekly business development goal? What's your rhythm? What's your strategy? What does your follow-up actually look like after a pre-approval, after a closing, after a realtor intro, after an application goes unfinished, or better yet, after you lose someone to a rate shopper? Do you still have a follow-up system to try to win that business back? If you don't, you should. How many meaningful outbound conversations are you having every week? If I'm coaching you, you need to have 10 meaningful conversations per day. What percentage of your business comes from each source? If you don't know that, that's step one. Know your numbers. What sources are growing? Which ones are more like vanity sources? Which ones are repeatable? Which ones are on the rocks? Maybe they're fragile. Most loan originators do not have a lead problem, although some do. But what they do have is a clarity problem. They do not need 27 new tactics. They need to stop confusing activity with strategy. That is why coaching and outside perspective matters so much. SCORE says, mentoring and expert guidance helps small businesses start, grow, and achieve stronger outcomes. And HBR's delegation research says leaders who delegate effectively can improve performance and free themselves for higher value work. For loan officers, intentionality means you stop saying things like, I need more business. Well, that's vague. Instead, say this: I need 2 more producing realtor relationships in the next 90 days. Or say this: I need my past client review request process tightened so I can increase social proof and therefore convert my referrals at a higher percentage. Or maybe you state the following: I need to become the obvious financing resource for all self-employed borrowers in my market. Or maybe you hit them with I need to replace random follow-up with a 12-month database nurture campaign. That's what intentionality looks like. Intentionality also means you stop waiting for content, networking, and follow-up to happen when you feel inspired. You schedule it. You standardize it. You track it. This is why some loan originators look naturally consistent. They're not, but what they are, they're systematized. And in this market, systems beat charismatic more often than people want to admit. The fourth lesson is the following: think bigger and you find you. This may be the biggest one of all because so many mortgage brokers are still operating like lone wolves in a business that increasingly rewards leverage. The average originator asks, how do I do more? The better question is, who helps me do this at a higher level? Who helps me tighten my scripting? Who helps me build a better follow-up process? Who helps me create content that actually positions me? Who helps me understand my data? I mean, like knowing your numbers. Who helps me recruit better? Who helps me run a cleaner borrower experience? Who helps me stop capping my business at what I can personally improvise? The reason this matters so much is simple. At a certain point, your business stops being limited by effort and starts being limited by design. You do not need personally to master every function. You need the right people, yeah. You need the right training, sure. And right operating rhythm around you. That's not a weakness, by the way. That's like being an adult and running a business. Harvard Business Review's recent research on delegation makes the same point from the leadership side. It states effective delegation is critical because it frees leaders for high-level work and can improve earnings and team capability. Loan officers may not think of themselves as leaders yet, but if you are trying to scale a book, create referral predictability, or eventually build a team, you are already in leadership whether you admit it or not. And thinking bigger matters just as much. A lot of loan officers are not underperforming because their goals are too ambitious. They are underperforming because their goals are too small and too vague. They are trying to close a few more deals. They are trying to get a little more serious. They are trying to post more content. Y'all, that's not vision. That's fog. Thinking bigger sounds like this. I want to become the most trusted purchase-focused originator in insert your zip code. For me, 32708 or 32765. I want to own a niche known to my market is serving well. I want to build a business that survives rates, it survives referral, partner turnover, it survives company changes and market mood swings. I want a model that is not dependent on luck. That kind of thinking changes your behavior. It changes who you spend your time with. It changes what you're willing to tolerate. It changes what you invest in. It even changes how fast you move. And it changes how honest you get about the holes in your current game. That is what I want mortgage loan originators to hear from this episode. These 4 lessons are not abstract. They're a blueprint. Measure the gain, not the gap. Stop staying too long in misalignment. Trade drift for intentionality. Think bigger and go find your who. And if you do all of that, this market becomes something different. It stops being punishment. It becomes a separator. Because let's be honest, easy markets hide weakness. Tough markets reveal professionalism. There's a reason so many originators aren't doing well, yet so many are. When rates are low and refis are falling from the sky, a lot of people can look competent. When rates are around 6%, inventory is still tight by historical standards, and purchase business has to be earned, the professionals separate themselves. This market is where skill matters. So if you are a loan originator or a mortgage broker and you're watching this, here's your challenge. Do not just listen to these lessons and nod. Audit your business against them. Where are you living in the gap? Where are you tolerating misalignment? Where are you drifting without intentionality? Where are you still trying to be your own how instead of finding the right who? Think about that one. Because the next level of your business is probably not hiding in another random tactic. It is hiding in better thinking, better structure, better accountability, and better execution. And that is exactly why we have built TLOPS Originator Coaching. If you know you are capable of more, but your business needs more structure, more systems, more accountability, better strategy, and the right people in your corner, go sign up for TLOPS Originator Coaching Community. Our community is for the originator who's done winging it. They're done guessing. They're done going at it alone. They're done trying to figure it out. They're done being lost. They're done calling inconsistency the market. They're also done trying to build a serious business without serious support. Look, I built TLOPS Originator Coaching Community to help you sharpen your sales process, tighten your business plan, create intentional growth, and surround yourself with the right people so you can stop spinning and start scaling. And I did this all without asking you to break the bank or to give over your firstborn or to chop off a finger. It is the number one value in business coaching for the mortgage industry. If you want to get signed up, all you have to do is go to our website. It's tloponline.com. Click coaching. You can check out a free 14-day trial. You can also schedule a call with one of our client success managers. My name is Dustin Owen, and this is The DO Show.